Welcome to the My Retirement Clarity Podcast, where our goal is simple, to help you close the gap between what you know and what you implement. The team at JL Perkins Wealth Management does this by helping good people make great decisions so they can enjoy an amazing retirement. And now, here's your host and financial advisor, Lee Perkins.
Okay, so let's go ahead and jump in. Keith and I are going to talk about an article from Carl Richards. Now, Carl he used to be just a financial advisor, just like Keith and I, and years ago, he kind of became famous. He's sort of known as the sketch guy now. So he does a lot of cool concepts with drawings and just kind of simple things. So the article that we came across from Carl is called "Pretending to be an Investor is Dangerous." So we're just going to kind of jump right in. There's 6 or so bullet points here, and Keith, if you want to start, kind of talk through the first bullet point, and then we'll just engage in the conversation from there. So if you want to take it.
Yeah, Carl's first point that he brings up, he says, pretend investors think that financial pornography is real, and therefore the news ticker scrolling across the television screen represents actionable information.
All right, so kind of one of the first things that jumps out, we know, from a real investor standpoint, this is entertainment. That's all it's meant to be. But where people get in trouble is when they start taking a lot of the stuff that we see on TV as the gospel, and they sort of act upon it. So I'll let you kind of take it.
Well, yeah, 100%. I mean, in this case, he's talking about the ticker scrolling across. I mean, you've all looked on Fox Business or Bloomberg or some other financial program, and they've always got the ticker going. And pretend investors, they'll see that. We see the ticker's going up. The S&P's going up, or the Nasdaq's going up, or an individual stock's going up, and then they'll react emotionally and they want to jump on the ride, right? But
because they think they need to make a decision or react right now.
Yeah, correct. Or something maybe that actually might be more that we see more with some of our people is, if they're not invested the right way, or even if they are, sometimes again people invest emotionally, and when they see the ticker going down and the market's having a bad day, people tend to get nervous way too quickly, and they want to jump out of the market just because the market's gone down 1.5% in a day, which
right.
Might be a pretty big drop, but as we see, then the next day it can be up 1.5 or up 2 points, or it might recover that in 3 or 4 or 5 days. So I mean, it's good information, certainly, but it's just data, right? It doesn't necessarily guide you or inform you to make a decision to get in or out of the market just based on the fact that the market's going up and down, because that's what the market does.
Exactly.
It goes up and down.
Well, and when you look at those shows and kind of the evolution of those what Carl calls financial pornography networks or shows, They dress up the sets. They try to make everything look like Sports Center. Like even with Jim Cramer, he's got buttons everywhere and sirens, and he's doing this and doing that. All those kind of things are meant to do one thing, is to keep you entertained between commercials. Because what we have to remember is everybody there they're selling commercials in between their 4 or 5 minutes of airtime. Now, if the prudent investor kind of has more of the long-term investment approach, they're not buying and selling every day, they're not watching all this. If we did the Prudent Investor TV show and I came on there, maybe you came on there and said, hey, market was a little volatile today, it was up X amount, or today and it's down X amount the day before that. Tomorrow we're just going to hold tight and see what happens. Tune in tomorrow and we'll see you on tomorrow's show. Nobody's watching that show, right?
No, 100%. I mean, and they have to keep eyeballs on the screen, and we were, before we started the podcast, we were talking about a few of those shows with like Charles Payne and Jim Cramer, and if you've ever watched Jim Cramer show, he's got buzzers and sound effects and bye and exactly. All these kind of things, and
it creates a sense of urgency, and people fall for it.
Yeah, right. And, they've got to have something to talk about every day. And I guarantee you, if you tracked a lot of the advice that you see on these shows, they're going to be wrong a lot of the time. I mean, they're going to be right sometimes too, and it's not that these people aren't smart individuals, but again, they need something to talk about every day, and just because they're talking about a particular subject, stock, or sector, or area of investing, it's just information. It doesn't mean that's what you need to be investing in at that moment.
Yeah.
So.
It's not only TV. I mean, you can look at things that you get on email, because we now know that your phone's tracking. Every place you visit on the web tracks you. So you know, we get emails all the time from what I call gurus. You know, this guy predicted the last crash, or this guy did. Well, if you're making some type of prediction on everything, eventually you're going to get right. But nobody's ever saying, hey, I got this one thing right, but man, I got these 57 wrong. It just doesn't happen. So.
Well, and I always think it's interesting, if you watch those shows enough, I mean, a lot of times in the same show, they'll have one guy's opinion on, and then if not the next guest, you know, later that day or later that week, they'll have another so-called expert on, and he's contradicting the guy that was on earlier. And so what you find is everybody's got an opinion, and usually it's somewhere on a spectrum. And again, it's just their opinion. And I always wonder when I watch these guys, you know, they have an angle too. Some of these guys are invested long in some of these kinds of investments, and they're literally marketing their investment, because if a lot of people see them and jump in and buy, then it helps his investment. Everybody's
selling something. So, all right, cool. Let's maybe jump into the second point that Carl's talking about in the article.
Yeah, Carl says pretend investors think it makes perfect sense to change their investments based on what they hear in the news. There's a new president, so you need to act. He doesn't like the Federal Reserve, so trade. He criticized bankers, so buy bank stock.
Yeah, so this is basically, his point here is talking about the news of the day. And obviously we're in the thick of, you know, we've got a new president, and he's doing a lot of things. Some things he says he's going to do. He has taken a bunch of action in the first, you know, as we record this, 4 or 5 days after his inauguration, he has taken a lot of action, and people are quick to sort of jump on to whatever. I mean, we were talking a little bit about this. What is it? The Stargate?
The new AI initiative.
The new AI initiative, and I think they're going to pour like $500 billion in that. So there's some companies and some banks that are heavily involved in that, and I guarantee you there are people that are out there wanting to get in on that because they think that's the next big thing. And right now, AI is the big thing. But you know, if you go back 3 or 4 years ago, almost every time my phone rang, it was somebody asking me about pot stocks, you know, because they're going to legalize marijuana, and I didn't need to put money there. And so people were throwing out obscure companies, and they'll do the same thing with here. And it's the pretend investor is going to try to chase one of these companies. The prudent investor, I think, is going to be more or less invest in a sector, use professional money managers, let them do the due diligence. And those guys aren't listening to their buddy at work push a particular company, right?
Yeah, I mean, 100%. I mean, you know, people invest in these kind of things. I mean, you're looking at venture capitalist kind of companies, you know, that they're taking a lot of funds from a lot of different people, and or they're, you know, if they're investing quite a bit of their money, you know, they're going to be diversified around a bunch of different investments too. It's just not prudent investing a lot of times to hop on the next new thing for your average investor who's, you know, risking their retirement funds,
right?
In these kind of investments. Like you said, there's always a hot new thing, whether it was the pot stocks a few years ago or a couple decades ago, you know, the turn of, you know, the century, it was the .com stuff,
right.
and you know, for every Amazon there was 150 companies that went to zero, so or more, a lot more than 150. So
sure,
you know, to put your eggs in a single stock or a single kind of investment like that, it's just that's some high flying risk. I mean, you might as well just go to Vegas and put it on black. You're probably going to have as good odds.
It's a lot of risk there. That's why for most of our clients, we are using professional money managers who I guarantee you every company that are in the funds that they manage. Now, we don't use a lot of mutual funds here. We use mostly ETFs. There are some individual companies, but all of those companies, I guarantee you everybody is using AI. So if there's no reason for us to try to find that one hidden company, because do you think Microsoft is not investing heavily in AI, and Apple and some of these other? They absolutely are. So that's why we try to just make sure that I think we talked earlier about how our investments may not be flashy. And what did you say about Warren Buffett at the time?
Oh, well, I've heard several slick investors over the years that they kind of, not really, I mean, obviously they respect Warren Buffett, but a little bit they mock him a little bit about how boring his investing is. And, all he does is sit around and read profit and loss statements of companies. And that just sounds like a terrible way to spend your time. Well, sound investing is not high flying. It's not.
Right.
It's if you're getting a rush out of investing, chances are you're gambling. You're not really investing.
Exactly.
You're investing in a way that you're taking on so much risk that it essentially is gambling. Sound investing a lot of times can be boring. And like I said, going back to Warren Buffett, he's just reading profit and loss statements, and he's figuring out what the fundamentals are of sound companies, and he's just investing in sound companies.
Exactly. Yeah, he's not very flashy at all. So, all right, let's jump to the next one. I think this is number 3 on our list.
Yeah, Carl says, pretend investors think they need to monitor their investments all the time. The little supercomputer they carry around in their pockets, known as a phone, makes it so easy.
Yep. So this is something that I've seen really a lot of, been in the business since about 2006 or 2007. Our access to information, our access to data and statements and everything, it's literally at our fingertips at 24/7. So I always tell the story, and I've done that on this podcast before and in other things, talk about how when my mom is guilty of this. She would check her accounts before she retired. She would log on 4 or 5 times a day and just see what her retirement account did. And after she retired, she sort of still continued that. I'm like, why in the world are you doing that? You're driving yourself crazy. It's the stock market is the one thing that you have the least amount of control over, and you're driving yourself crazy checking it 3 or 4 times a day. If we go back to 30 years ago when there was no internet, no access to anything, and you got, the value, you either had to call your broker, ask what the value of your account was, or you wait until you got a statement in the mail. I would tell you, I'm not so sure it wasn't better back then, because as you and I both know, the biggest hindrance to somebody investing their own money is themselves, because we're emotional. We make emotional decisions. We take all this information, and if the market drops 1% in a day, people think they got to do something. No, you don't have to do anything.
Yeah, no, I totally agree. I mean, really, the only people that should be constantly looking at the market and seeing what they're doing, some of the guys on Wall Street that are doing ultra technical investing, and it matters, what they're buying and selling from day to day, or like a day trader, which I would advise that's terrible too, because most day traders, they're literally gambling, and most people that want to get into day trading they wind up losing their money.
Exactly. So if you are listening to this show, you are not a day trader. Hopefully, you absolutely should not be a day trader. If you're a professional day trader, you don't have time to listen to the show. You don't have time to do anything except watch something.
Yeah, absolutely. I mean, obviously, our perspective here and kind of the way we do things, we come from a more strategic, passive investing standpoint, and we look at investing things in a diversified manner around a lot of funds or a lot of stocks bundled together, and that helps reduce the risk rather in quite substantially. I mean, if you're picking stocks, even if it's a Microsoft or Amazon, and you've got a sizable part of your or percentage of your portfolio in single stocks, ultimately it's just not a good idea. I'm sure everybody that had a large part of their money in WorldCom, or unfortunately for some of the employees, they had virtually all their money in WorldCom. Yeah. Well, if you're in a single stock, you're subject to business risk, and any business can go to zero at any time if the right conditions happen in the world.
Correct. So. Yeah.
Hey folks, Lee Perkins here. I wanted to tell you about our brand new book called Next Phase, How to Retire in a Year or Less Without Regrets. It's all about helping you prepare for the next phase of your life, whatever that looks like for you. So, if you're ready to make the most of your next phase, or if you're already retired and aren't sure you're doing all you can to get the most out of your retirement, then you'll want a copy of this book. All you have to do is text Next Phase to 478-475-2050 and we'll send you a copy right away. You can also access additional resources and register for one of our upcoming workshops at our website, www.myretirementclarity.com. Thanks for listening. Now back to the show.
All right, let's jump on to the fourth one here. So looks like we're about halfway through Carl's list.
Oh, yeah. So he says, pretend investors talk about their investments a lot. They say things like, I'm long this or short that. They use jargon that often does not make sense, though it sounds kind of impressive if you don't listen too closely. Sometimes they cheer for things like increased consumer spending, higher unemployment, or in some cases, even war.
Yeah, so these are people listening to talking points using high-level terminology. Those folks, they pretend like they're more interested in the global economy. At the end of the day, we all need to be worried about us, our personal economy, take care of things you can take care of, and because that is what you can control. So I got news for every listener out there. There's not a politician up in Washington, whether any that you like or don't like. Those people do not know you, and they really don't care about you as a person, and they're not going to call you before they make any decisions. So take care of you, take care of yourself. I mean, we're a big believer of hiring somebody professionally to manage money, and that's one of the reasons why we do what we do. Kind of our vision here at the office is we help good people make great decisions so they can enjoy an amazing retirement. I think far too often, and you've seen this in meeting with people leading up to retirement, man, all anybody can think about is their account. Right. They've got the typical questions, concerns. Do I have enough money to live on to get me to the end of time? And they're just hyper focused on their money and their account. 3 or 5 years into retirement, what happens? They eventually, for the most part, not everybody, they all wind up saying what? Man, we got more money than we're ever going to need, and we're going to die with a lot of money. You've seen that as well. Oh yeah, absolutely.
It's easy to say, and it's difficult for new retirees to do because, when people turn the income spigot off in terms of their day-to-day job, there's a lot of fear there. But as time goes on and they realize, the sky's not falling and
right.
The market goes up and down.
Despite what they say on the news.
Yeah, and they're still enjoying their life that it's going to be fine. And I would say, for people that have to look at the market every day or that are looking at it all the time, if you're doing that, you're doing retirement the wrong way. Right. Our goal is to get our clients to invest at a risk level that they're going to be comfortable with riding out the ups and downs of the market, because we have that crystal ball on our table because we often get asked how the market's going to do, and it's a bit of a joke here in the office because we joke the crystal ball doesn't work. Yeah. We don't know if it's going to go up or down. Yeah, absolutely. We'd all be a lot richer, right? But it's going to go up and down, and the more we can get people to invest at a level they're comfortable with, then it doesn't really matter if it's going up or down. We know historically the market goes up over time, and so if we can get people to invest at a risk level they're comfortable with, then they can forget about paying so much attention to the market, and they can get out there and enjoy their lives. Because as we all know, time isn't infinite in terms of our lifespan, right? It's finite. So we want to get out there and use it wisely and enjoy our lives. So.
Exactly. So I just thought about this. One of the other big detriments for people, I said earlier, one of the biggest problems in an individual investor is themselves, because we're all emotional. We make decisions based on what we hear on the news and all those kind of things and see in the media. Boy, I'll tell you, another big problem is the coworker that is by the water cooler talking about they made just a a blank ton of money in this stock, or they just made a killing in this. And it's crazy because that person comes off as sort of a guru, but when you dig deeper, there's not a guru. I mean, they can't predict the market every time, and they are never coming to you and telling you about their losses. They only tell you when, they like to brag when they make money, but nobody likes to tell you when they lost money.
Yeah, they look brilliant when they vocalize their winnings. I mean, I might win some money at a blackjack table every once in a while, but for the most part, I'm going to lose money, right? And so, like you said, nobody's out there broadcasting their losses. So, you can definitely be influenced by peers and other people, talking about things, but it's generally not a great idea to compare yourself with others. You just kind of got to live in the world we're in, and don't get caught up in the hype. I would say that's the biggest thing. A little bit about that is, the last few years what are the biggest hype things? You had the AMC stock thing, or the GameStop stuff, right? And so that's 100% gambling. The people that got caught up in that. And then I'd say the next biggest thing, especially the last couple of years, is crypto, right? Everybody wants to talk crypto. That's crypto, the new shiny penny.
Dogecoin, everything.
And I don't think the hype on that is gonna slow down anytime soon, especially with some of the initiatives that the president's been talking about doing, and he kind of wants the United States to be the leader in crypto and all those kind of things. And I do think it's going to be something that's going to stick around, but which coins to invest in and all these kind of things. I mean, again, these are much higher risk kind of investments and really aren't appropriate for most people's retirement investments. Yeah,
it's all speculative. And every once in a while we will run across, that 65-year-old person. I can't tell you how many times a 65-year-old grandmother comes to me and says, hey, my grandson says I really need to put a bunch of money in crypto. I'm like, no, you don't do that. If your grandson, who's 21 years old and spends all of his time on the internet reading things, he lives in a different world than you. If that guy wants to put his money in crypto, that's fine. But no, the 65-year-old grandmother does not need money for in crypto or something.
And I think it's more these companies, and time will tell, right? But I think it's more these companies like BlackRock and some of these other, just mega financial companies out there create funds, ETFs, and things like that, and some of the institutional investors start investing in people's pension funds and stuff. Maybe there'd be a small place for a very small percentage as part of an overall portfolio. But if you got somebody out there trying to talk you into going and buy Bitcoin or Ethereum or especially Dogecoin or some other kind of meme coin. Trump's got a coin out there now. Trump coin.
Yeah, you bought your Trump coin yet?
No, I don't. It's kind of funny, but yeah, I would definitely not do that. There's massive risk, not only just the investment itself, but if you're trading those coins on exchanges, there's all kind of security risk and ways for people to steal your money and all those kinds of things. And it's in the subject matter that we're talking about in terms of retirement investing, there's just really not a lot of room or place for that sort of thing, in my humble opinion.
Yep,
anyway.
I would agree. All right, let's jump on to number 5. We're kind of getting towards the end here.
Pretend investors worry endlessly about the news in some far-off part of the world and the impact that news will have on their portfolio.
So every once in a while, as news happens, there's always something way overseas that the news jumps on because we live in a 24-hour news cycle. They search for stories that 20 years ago, before the internet was a thing, we never would have even heard about these things. You just wouldn't have heard of them. But now the news, all of the news outlets will jump onto a thing and it does nothing but cause fear. And I've told people really for the last, I don't know, however many years, just turn the news off. Be informed, but turn it off, because the news is there for one purpose. Is that everybody has an agenda, and it really does nothing but steal your joy.
Yeah, and the truth is, if I'm being honest, we all get caught up in that sometimes, and then we just have to recalibrate and turn the news off or whatnot. But I've heard you say it before, and I think that's super wise. Is people, and including ourselves, sometimes we can get too focused on things that we have absolutely zero control over. And those do tend to be the biggest joy stealers, or things that worry and anxiety about things that we have zero control. I mean, most of these things that we hear in the news, especially like you said, overseas things or whatever.
There's always a crazy leader in some country way across the country or the world that always rears his ugly head.
Well, yeah, and again, unless you're investing like in or world disasters. I mean, unless you're investing heavily in commodities and things like that, which again, those are high risk, high flying types of returns. It's all speculative. Unless you're investing in those kind of things. I mean, sure, when an event happens across the world, it might affect a particular commodity or a business or this or that, and that all kind of gets filtered through the economy. But overall, when something like that happens, it doesn't have a huge effect on you and your investing. It might mean that your eggs are going to go up a little bit if the bird flu's wiped out the egg supply, or it might mean that orange juice is going to go up, or something like that. But in terms of affecting your overall portfolio, if you're invested in a diverse way in a basket of funds and ETFs and that sort of things, it's going to have almost no effect on your day-to-day life.
Yep, you're right. I agree. All right, let's wrap up here with number 6, the last one here. I think it's a pretty good one.
Yeah, so Carl kind of wraps up here by saying, pretend investors complain endlessly about volatility in the markets and focus on days.
All right, so that's a good one, and I think I could even say as an advisor, I could be guilty of this. Some advisors are probably more guilty of this than others, because we're all trying to attract people to our firms, and the word volatility means a lot of things to a lot of different people. Volatility is not a bad word. I mean, the volatility in the market can sometimes be good, but I think lots of times people hear that word and they're like, oh my gosh, there's volatility in the market. What do I need to do? Well, as you and I both know, that it doesn't necessarily mean that you need to do anything. That's why I think you said earlier, we want to build portfolios for our clients that they can live with in up markets and down markets. And so the day-to-day volatility doesn't matter. I mean, because people know what I do for a living, I may go to lunch with somebody and they say, hey, what's the stock market doing today? And I'm like, you know what? I don't know, because I didn't look at the stock market before I left the office. And you know what? Here's the insider tip. I didn't really look at it at the end of the day yesterday, because it doesn't matter to me or my clients what happened in the stock market yesterday or today. What does matter is maybe what happened over the last year or 2 years or 3 years or 5 years. And those are the trends that we're trying to look for. The money managers we use, they are doing all of that due diligence. We are not making decisions on what happens from a day-to-day basis.
No, I mean, absolutely not. I mean, like I said, our clients and your typical retiree investors, the crazy volatility in the long term is not a big deal. Right. Yes, a ton of money is lost in the market on your most volatile days, but we're talking about the Gordon Geckos of the world.
Sure.
Throwback to the movie Wall Street.
It really is a good movie. A lot of crazy truths in that movie.
Yeah. So if you're a high flying investor that's doing taking crazy risk on companies and things like that, sure, the volatility going up and down. There's a everybody talks about 2008, but more money was made and lost with those type of investors just taking crazy risk on things. And but for your typical investor, I try to compare it to noise. I mean, volatility is just noise, and it's because 100%. You're hyper focused on the day. And like you said, as long-term investors in your retirement, it's really better to be focused on, not even the quarter. I mean, zoom out even further. I mean, we want to start looking at, how it did for the year, over the last couple years, and that sort of thing, because you can be just too reactionary. And typically when you make important or decisions quickly based on a small amount of information, it's hard to make good decisions.
Yeah, no, it really is. So the thing that I've kind of withheld from everybody here listening to the podcast today, this article from Carl Richards, man, I think this is so relevant today, because some of the things that we talked about with, there's a new president, so act on this or act on that. When this article was first published, I think it was like 2012. Okay. And so when I searched it again, because I thought it was a relatively new article, it was published like 2012. And then all of this topics can be relevant every single year, or in 5 years, or in 10 years, because nothing changes except the news, how we consume that news, and the decisions that we make or we don't make based on that news. So it's a really good article, and we'll dive into some more things like this into the future. But good conversation. Any closing thoughts for you?
No, like you said, I think these are not only, a lot of what he brings up here aren't just good investing principles, but it's really something you can take just in your day-to-day life, not to overreact to short-term events, and to kind of take the long view on things, and really just not let the noise of the day drastically affect your decision making. Slow and steady wins the race. So.
Absolutely, and eventually, one of the things that I try to tell people, eventually people wind up realizing, usually it's later in life, that the number one, the most valuable resource that you have is your time. Yep. Do we want your money to grow? 100%. And we're going to be a prudent investor. We're not going to be a pretend investor with our clients' money. But remember that as we close the show here today, your time is 100% more valuable than your money. So anyway, appreciate everybody tuning in, and we'll see you next time. Hey there, Lee Perkins here. If you're like a lot of folks, you've been listening to this podcast for a long time now. But I've got an important question for you. Have you implemented any of the ideas that we've discussed on the show? If you haven't, what are you waiting on? You know you're not getting any younger. So here's my challenge. Don't just consume the content. Our number one goal for this podcast is to help you close the gap between what you know and what you implement. So if you're ready to implement, take that first step today and visit www.talkwithjlp.com and schedule a 15-minute phone call with one of our advisors, and we'll help you close the gap between what you know and what you implement so you can enjoy the next phase of your life. Now is your time. Don't procrastinate any longer.
Investment advisory services are offered by J.L. Perkins Wealth Management, a registered investment advisor and insurance agency. Information is for illustrative purposes only and does not constitute tax, legal, or investment advice. Always consult with a qualified tax, legal, or investment professional before taking any action.